Welcome back to the Atlantic Council. I'm Josh Lipsky, Chair of International Economics at the Council, Senior Director of our GeoEconomics Center, and I am so pleased to welcome to the stage external member of the Monetary Policy Committee at the Bank of England, Greene. Welcome back to the Council.
Yeah, thanks. It's nice to be back here.
So we have a lot to talk about in the UK economy, and then I also want to get to the global economy and your impressions during IMF-World Bank Week. But let's start right in the UK. Your policy area, your work at the Bank of England, and let's talk about inflation. We have had this conversation now going back 18 months where you have come either at our studio at the IMF or here at the Council and said you were concerned that inflation might stay higher than some forecast. And I see that some of your colleagues at the Bank of England seem to be agreeing with that. The IMF flagged some of these risks today. They project inflation at 3.4% this year, but the risk of it staying persistently higher than previously projected. How do you see the inflation picture in the UK?
Yeah, thanks. So at least I'm consistent, I suppose, because I have been saying this message for about a year and a half now, at least. So inflation in the UK has been rising for a couple of months. Actually, it's been rising for a year, but in particular, we've had a near-term hump in inflation. And so there are questions about what's behind that. Quite a lot of it is administered prices, so sort of one-offs, water, things like that, that we can do nothing about. So that is something that we're inclined to look through. Some of it is energy, but the reality is a lot of these administered prices kicked in April, and as I said, inflation's been rising actually for about a year now. And so my question is whether there's something more intrinsic behind that. If you look at core inflation, which economists like to look at, stripping out food and energy prices, it's been sideways for the past year. If you look at services price inflation, different metrics of it, some of them have been going sideways for the past year, particularly if you look at higher frequency measures. So these are all indications that maybe the disinflationary process is slowing, which is something that I've been worried about. Inflation expectations have been rising in the UK and are kind of, so for both households and businesses, they're kind of at the upper bands of what we can really explain given normal relationships between inflation outturns and inflation expectations. And so the concern is that if you have rising inflation expectations, that will feed through into wages and prices, and you'll get second round effects, and it becomes this cycle. That's what we had back in 2022 when inflation peaked at over 11%. It's worth pointing out that we think inflation will probably peak around 4%, so that's a magnitude of difference. And so it's not the same as what we had in 2022. Also, the economy is in a fundamentally different place. So the labor market was really tight when inflation peaked. Actually, there's slack that's opened up in the labor market now. So that suggests that even if inflation expectations are high, workers aren't really in a position to go and push for higher wages just because there's slack in the labor market. So the kind of wage part of a wage price spiral might be less likely now than it had been before, and that's good news. And we have seen wage growth coming down in line with what we've been expecting as pay settlements have come in over the course of the year. So that gives me some hope. But on the other hand, price setting is the other piece of a wage price spiral. And we ask firms in a regular survey about their price setting, and it turns out that firms are much more sensitive to upside surprises and inflation in figuring out where they think their prices will be in a year's time than they used to be when inflation was lower. And so that suggests there might be something in the price setting process that's changed a bit that could mean that inflation could be more intrinsic. And so the disinflationary process is still underway. It's partly underway because of what the Bank of England has done, so the MPC has done with restrictive policy. We've been cutting interest rates for just over a year now, right? So interest rates have come down. So there is a question about how restrictive our monetary policy stance really is right now, and it's less restrictive than it was before we started cutting bank rate. There are lots of different ways that you can try to measure how restrictive your stance is. They're all imperfect and woolly and difficult, but all of them suggest that we're still restrictive, but we're not meaningfully still restrictive. And so insofar as I'm concerned about inflation being more persistent than we had been thinking, I am also worried that we have a less restrictive stance, and so that just suggests that maybe we should slow down in our rate cutting cycle.
And when you say slow down, does that mean slow the pace of rate cuts or stand steady where you are?
Yeah, that's a great question, and slow down relative to what, right? And I guess I'm speaking about, slow down relative to what market expectations had been previously, at least, which was kind of an assumption that we'd cut every quarter. I think it's probably appropriate to cut more slowly. You ask, does it mean just stopping? So another way to ask that is, do I think our rate cutting cycle is over? And I don't think it is. So I do think we're still in restrictive territory. We're just not meaningfully restrictive, and that's a concern to me.
I went back to our interview 6 months ago, and you said specifically, I'm worried that inflation could plateau instead of being a hump, basically, the backside. I think we're seeing some of that play out. But what data points are you now looking toward going forward? So if we do this again in 6 months, an invitation is standing back at, that you can say, no, we are on the backside of it, and we're seeing the trajectory you want to see from the Bank of England side.
Yeah, so there are a few things that I'm looking at. Inflation expectations, which I've mentioned, which have been ticking up and are really elevated. I'm looking at that, but also there's a lot in the labor market that I'm looking at. I had been worried previously that we might see kind of a shakeout in the labor market off the back of the increase in the national insurance contributions and an increase in the national living wage. We haven't actually seen that. We have seen some adjustments. So unemployment has ticked up very slowly to 4.8% in the most recent data print. But that's not a shakeout. It's a weakening of the labor market in line really with what we had been expecting. And so slack is opening up. That's important because it affects wages. And so I'll be looking at wage growth. So far, like I said, pay settlements are coming in line with what we had expected for this year, although the latest data print had wage growth, surprise on the downside. Yeah. And so that if wage growth is lower, then that takes some of the upper pressure off of services inflation, which takes some of the upper pressure off of inflation. So I am looking at that. Another thing I'm looking at is consumption in the UK economy. So I gave a speech just over a year ago about consumption in the UK economy because we keep assuming that the UK consumer will start spending as interest rates are coming down, and it keeps not happening. And so we keep saying, well, no, it's going to recover. And so the savings ratio, kind of the flip side of that, is still really high. So there's a question about whether the consumer really will kick in. And consumption is about 2/3 of most developed economies' growth, right? So if you don't understand the consumer, you're missing a big trick. So if the consumer comes in much weaker than we had expected, that would keep upper pressure off of growth. So growth would be even weaker. And that on balance could be less inflationary than I'm worried about.
I wanted to ask you about growth. IMF revised up UK GDP growth projection just slightly, 1.3%, I think, from 1.2. But it does create a bit of a balance here as you think about growth. Second fastest in the G7. I saw the Chancellor talk about that. So now you have growth a little better than expected. Does it weigh into your calculations when you balance it with monetary policy?
It does, because it affects the demand side of the economy. So it does matter. If you look back to kind of where we were expecting the UK economy to be a year ago, so where we were expecting to be right now when we were making predictions a year ago, growth is stronger, inflation is stronger, and wage growth is stronger now than we had expected a year ago. So growth fits into the picture. I would say in the UK we have monthly GDP reports, which if you're focused on the US, you don't have monthly data. And so the monthly data
We don't have any data now.
Well, at the moment, that's right. That's right. But, monthly data can be pretty volatile, and so there has been strength. More recently, there's been weakness. We tend to look through some of that volatility, and we look at sort of our own indicators of underlying growth based on surveys and other things. And that hasn't shifted that much. So underlying growth remains fairly weak in the UK, and we expect that to continue over a forecast period. So there should be a modest recovery, but not significant.
I wanted to ask you about the Monetary Policy Committee a little bit because we've talked about this before. It's a different setup than in the US and the Fed. The 2 meetings ago, I think it was a 5-4 decision. You dissented. I think it was a 7-2 decision last time to hold rates steady. Could you just take us inside, what it's like to have a Monetary Policy Committee with real debate and division. We're having a little more of that now in the US than we used to, but certainly not as much as traditional in the UK.
Yeah, in fairness, I do think there is a lot of debate at the Fed, but when it comes to dissenting, it's much less common in the US than it is in the UK. It's pretty common to have dissents in the UK, and also it's worth pointing out that the structure of the committee is different in the UK, and that we have internal members and external members. I'm an external member, so the point of having external members is to bring people in from outside, whatever that may mean, outside the industry, outside the country in some cases. So the idea is to bring in people who will bring a different perspective, and that kind of foments debate, right? And often it brings disagreement. So it's typical to dissent. We also have our votes attached to our names, so that does provide accountability as well.
And no dot plots? You do the same type of thing as we have at the Fed?
We don't have dot plots.
Yeah.
I'm a huge fan of dot plots, actually, but we don't do them at the Bank of England.
So just final question on inflation. Do you feel that things have moved a little more to your way of viewing things from the time we talked a year ago from the rest of the committee?
That's a good question. So I think we spend a lot of time talking about inflation persistence, and we've always produced a central forecast, but at the Bank of England now we're also producing scenarios, just to think about the risks around our main forecast. And so we spent a lot of time looking at inflation persistence, and so that's always been a concern. Even when we weren't formally producing scenarios, we were discussing that. And we've also looked at kind of a downside scenario with weaker demand. So I think the risks are still two-sided, and we've been saying for a while that the risks are two-sided. A question is kind of where's the balance of risks, and to my mind the balance is on the upside for inflation, and my colleagues will have to speak for themselves.
Fair enough. I want to get to online questions as well, so everyone use askac.org if you're watching. But I want to turn to your speech, your fascinating speech last month, and then you wrote a column in the FT about it. Yeah. And it's how central bankers should think about supply shocks. And typically, as you talk about it in the speech, central bankers would look through supply shocks. That would be the standard kind of macroeconomic training. And you raised some questions about that and whether we need to reconsider. So if you could walk us through the thinking and then how central bankers should adapt in your mind.
Yeah, sure. So some of my motivation for looking into this is just that generations of economists, myself included, have only looked at the economy through a demand lens. And that's thanks to Keynes and post-Keynesianism and new Keynesianism. It's all kind of based on this idea that changes in activity are demand driven. But we've just come through some massive supply shocks, and so we've come to realize that actually the supply side matters quite a lot too, and can affect inflation in particular, and activity pretty significantly. So as you say, the conventional wisdom is that central banks should just look through supply shocks, in part because often they're just considered temporary. So an oil price shock, right? What's a central bank going to actually do about that? It's a one-off shock. It's a level change. So you can look through that. Inflation expectations, if they're anchored, then you don't really need to worry about second-round effects with supply shocks. And also, our main tool as a central bank is moving interest rates, and they're a demand management tool, really. They don't have direct implications on supply shocks. So for all these reasons, the idea is you can generally just look through supply shocks. But again, we've just come through two massive supply shocks, a pandemic and a war in Europe. And so I wanted to look at some of the lessons that we've learned. And some of the lessons we've learned is that, you can't really assume that inflation expectations are always anchored and therefore you don't get second round effects. That was our experience in 2022 in the UK. And now we're seeing inflation expectations rise again. And also kind of state contingencies matter. So it turns out when you've just had inflation of over 11% a couple years ago, people are a little bit more alert and sensitive to inflation. So the threshold for people paying attention to inflation when they're setting their expectations is a bit lower. So in the UK, it's around 3 to 4%. And so that matters. It also matters kind of what kind of inflation you have. So food is something everyone has to buy. Energy generally too. So food and energy price inflation tend to be more salient. And so people are more sensitive to rises in those things. Also people notice increases much more than they notice decreases in inflation. So these kinds of state contingencies really matter. And so you could have second round effects kick in. Also, not all supply shocks are created equal. So negative labor supply shocks tend to have a longer lasting impact on inflation than other kinds of supply shocks, like a wage price markup or lower productivity growth. In the UK, employment's about 1 percentage point lower than it was before the pandemic, at the peak before the pandemic still. So we have some difficulty knowing exactly what's happening in the labor market because of difficulties with data collection and survey responses, but I think there's a real argument that we suffered a negative labor supply shock in the UK, which would be more persistent. And so the question is, what should central banks do with all of this? The traditional conventional wisdom is to look through them. I actually think that there's a bunch of literature, and we've done some research at the Bank of England showing that central banks should be a bit more forceful if they're worried about inflation persistence, and also if they're just not sure, right? You can't identify a supply shock in real time unless it really hits you in the face, like a pandemic. You can't measure the supply side of the economy. So if you're a bit uncertain, as you might be in the face of shifts in supply, then you should be more forceful. That could mean, if you're in a cutting cycle, that could mean hiking rates. I'm against that. I think, about turns in direction for policy really undermine central bank credibility, but you can achieve the same outcome just by cutting more slowly. And so that's something I'm in favor of.
What has been the reception to the speech since? Have you talked to colleagues at the Bank of England, other central banks? Curious the feedback you've had.
Yeah, so I think people appreciate kind of putting together some of the lessons that we've learned, and I think there's a general acceptance in the central banking community that we probably do need to think about supply shocks a bit more often. Also, I think we're going to have more of them going forward, and I'm not the only one who said that. Jay Powell, the chair of the Fed, has said that. Christine Lagarde, the president of the ECB, has also suggested that. But between kind of climate, physical, and transition risks, those pose potential negative supply shocks. Economic statecraft tariffs can pose negative supply shocks. And so if we have more of them going forward, the chances of them being successive or actually happening at the same time is higher, and then you get sort of interactions between them, as we had with the pandemic and the war in Ukraine. And so, so there's a real acceptance that we need to think about it more. I've had a number of people in the central banking community reach out to me and say, this is really interesting. How do we think about things like tariffs and economic statecraft generally? So it's an area where a lot more work needs to be done, but it's good to have started it.
We're happy to do that work here at the Atlantic Council and contribute to it. This has been core to how we think about these issues and trying to rethink macroeconomics in a world of economic statecraft and geoeconomics. You took me right where I wanted to go, which is tariffs. The last time we met, it was 10 days after Liberation Day. We didn't know what the tariff situation was going to be, thoughts of a global trade war. Since then, there's a UK-US trade deal, there's an EU-US trade deal. We can talk about China separately. But the UK situation specifically, how do you see tariffs affecting the UK economy? And more broadly, how has the tariff situation played out versus your expectations 6 months ago?
Yeah, so for the UK economy, we expect, traditional wisdom would say for the country imposing tariffs, it's a negative supply shock. For the country, on the receiving end, it's a negative demand shock. But it's much more complicated than that. It depends on whether there's retaliation, what happens to the currency. As it turns out, the currency's moved in the opposite direction of what the theory would have suggested this time around. So on balance, it seems that the tariffs, even with the UK-US deal, drag on growth a bit. So by kind of 0.3 percentage points is what we had penciled in the last time we ran this analysis, which doesn't include the latest, greatest on global tariffs. And then for inflation, it's much more ambiguous, actually. So our view is on balance, tariffs should drag a little bit on inflation. And some of that is the direct implications of tariffs. Some of that is actually just uncertainty. And so relative to last time we were sitting here, right after Liberation Day, uncertainty had absolutely spiked, right? It's still pretty elevated. It's come down a bit. Interesting, what happened between the US and China over the past couple of days has probably increased it again a bit. And so I don't think we can be totally sanguine about this. But uncertainty, a lot of research shows that when companies have to make long-term capital allocation decisions, in an environment that's this uncertain, they just tend not to, and they sit on their hands, and so that drags on investment pretty significantly. And so that, on balance, could be disinflationary for the UK economy. But again, there's a lot of uncertainty around that. There's also, as we saw during the pandemic, when you gum up global supply chains, that's inflationary as well. So there could be some offsetting factors.
One thing we've heard in these meetings that's been interesting is that other countries have said, look, if you would have told me I had a 15% tariff or 10% tariff and a 20% tariff, that would have been very difficult for me to manage. But what I think countries seem to have realized, but wondering if this is true from your perspective, is that what matters more is actually my relative tariff compared to other countries versus just the bilateral. And that seems to be something we've heard come across this week.
Yeah, it can do, and that's also what the theory would suggest, because you have rerouting, you've got trade diversion in some cases, and so for the UK, actually, the sort of direct tariffs were not the whole story. It was also what, the UK's biggest overall trade partner is the EU, so what's the relationship between the US and the EU, and also, the US-China, it's important for the UK as well.
All right, I'm going to turn to one or two online questions before we wrap up. This one is, you've argued that external shocks play a larger role in UK inflation than traditional models assume. Do you think the bank's forecasting frameworks need to evolve in some way to incorporate global value chain data more explicitly? We've talked about this a little before.
Yeah, we have. So of course we do consider global value chains in our forecasts. Could we do more? I think, there are always improvements that can be made. The Bank of England, for those who don't know, is undergoing a pretty big review process off the back of their Bernanke review. And part of that is re-estimating a bunch of our models, developing a whole bunch of new models to use in certain occasions, and also just to serve as cross-checks all the time. So I think there is room for improvement, but I also think we're working on it.
Question here, there's a few, but I'll tie it together on the UK-EU relationship. We talked about the UK-US relationship, but the UK-EU side, how you see growth in the euro area, more broadly trade, UK-EU, the economic partnership here.
Yeah, sure. So growth in the Eurozone has also been pretty weak. Inflation's been lower in the Eurozone than it has been in the UK. The ECB's cut rates much more than we have. They have a lower neutral rate as well, so there are those differences. We mostly consider the EU in terms of the implications for the UK, and the biggest tie there is, of course, trade. In May, there was a common understanding that was established between the UK and the EU that suggested more cooperation in some areas. There have been a bunch of calculations of the implications of that for growth. I think the median is kind of 0.3 percentage points positively for growth for the UK over a number of years. I think by 2040 is the calculation. So relative to Brexit, that's an order of magnitude smaller than the impact that Brexit had on the UK economy, but it's a step in a positive direction, I think.
I wanted to ask you a question about the dollar. You referenced this a little in one of your answers. The relationship after Liberation Day between Treasury yields and the dollar moved differently than you would typically expect. And I've been having a conversation throughout this week with everyone we've had on. Do you think that was unique to that moment, or does it signal something that's fundamentally shifted about how the rest of the world invests and thinks about trading the dollar? And the question that's usually raised is the dollar going to trade like every other world's currency at this point when there's a problem or a shock, as opposed to how it typically has done in the past, where people rush toward treasuries even when there's a problem in the US?
Yeah, so I think if you look at risk assets, generally they've behaved a bit differently since Liberation Day. So the dollar hasn't recovered since Liberation Day fully. Also, if you look at gold, for example, it's been absolutely soaring. So there could be some signal in there that sort of attitudes towards US dollar denominated assets had shifted a little bit. The extreme of that would be kind of de-dollarization of the global financial system. I don't think that's what we're looking at, least of all because there's no actual alternative. So I don't think that we need to worry about that, but there could be sort of slow shifts in attitudes towards dollar assets as safe assets.
Okay, final question. We have 2 minutes. I want to ask you about the Fed. We are here sitting in October. By the time we meet again in April, there will be a new Fed chair named.
Yeah.
He or she may be confirmed at that point, probably will be, if all goes as planned based on the timeline we understand from the White House and Treasury. what does this mean for the UK-US relationship, the Bank of England-Fed relationship, how you think about having worked with Chair Powell and now working with a new Fed chair in the US?
Yeah, so I'd say when we look at what's happening in the rest of the world, we mostly look at it with a lens to kind of what it means for the UK economy, since that's what I'm setting monetary policy for. So how would a new Fed chair affect that? I think the biggest spillovers would come through kind of asset pricing. So, I have no inside view on who the next Fed chair will be. But, if assets reprice off the back of that, then there will be some spillover for the UK. So before the pandemic, about a third of the moves in our gilt curve were driven by things happening outside the UK entirely. Since the pandemic, it's about half, and most of that spillover and read across is coming from the US. So it would affect financial conditions for us, certainly. And then there are other questions, about sort of central bank independence, and that's something I think everyone's looking at. And I guess I just want to state how important I think it is.
Yes.
If you want to have inflation expectations well anchored, there's a lot of research suggesting that the outcomes are better when the central bank is independent and is viewed to really have one objective, which is to keep inflation expectations well anchored so that they can achieve a mandate, whatever that mandate may be. Often it's inflation targeting. And so the independence of central banks, I think, has been proven to be more effective in achieving those targets than when central banks aren't proven. So, I think it's really important to maintain that.
I think that's the perfect note to end on. Megan, thank you once again for joining us at the Atlantic Council. We wish you best of luck this week in Washington,
Thanks.
Best of luck back in London, and you are always welcome here at the Council.
Thank you.
Thank you, everyone, for joining us today. This is our final event at the Atlantic Council of IMF-World Bank Week. We have a series of events back over at our IMF studios this afternoon. You can find the full agenda on our website. We thank everyone for joining us, and we wish you a pleasant rest of the day.